Welcome to the deep dive. Today, we're getting into something really fundamental for anyone looking at company financials, the auditor's opinion.
Yeah, it's that statement right at the front of the audited financials. Crucial piece.
Exactly. We've got some materials here that break down how auditors actually form these opinions and, what the different types mean.
Mm-hmm.
Our goal is really just to cut through the jargon, make it clear what they're signaling.
Sounds good. Because it's not always straightforward.
Right. So, the big question for you, the listener, what's an auditor's opinion really saying and what signals should you watch out for?
Fundamentally, the auditor's job is to give an opinion on whether the financial statements are presented fairly.
Fairly, meaning?
In all material respects, they follow the rules of the applicable financial reporting framework. Think U.S. GAAP, usually.
Okay, U.S. GAAP. And how do they decide if it's fair? What's the process there?
It boils down to three core things they have to consider.
All right, let's hear them.
First, did they get enough good audit evidence? Sufficient appropriate evidence is the technical term.
Okay, evidence. Like what?
Well, things like observing inventory counts, confirming balances with banks, testing transactions. This is all guided by GAS, Generally Accepted Auditing Standards.
Got it. GS for the process, GAAP for the rules. What's number two?
Second, they look at any mistakes they found that haven't been corrected. Are these misstatements individually or added together? Material.
Material meaning big enough to matter to someone reading the statements.
Exactly. Big enough to potentially influence a user's decision. And third, do the financial statements actually meet all the requirements of that framework, like GAAP?
So making sure they followed the specific accounting rules.
Precisely. Like under GAAP, you don't depreciate land. Simple example. But they check countless rules like that.
So evidence, materiality of errors, and sticking to the accounting rules, that's the foundation.
That's the core valuation, yeah.
And when they're looking at the financial statements, what specific things are they judging against these factors?
Oh, quite a bit. They look at whether the company's significant accounting policies are adequately disclosed. Are they clear?
Okay.
Are those policies appropriate? And were they applied consistently?
Consistency matters.
Hugely. Also, are the accounting estimates management made? Because they're always estimates reasonable. And are those disclosed?
Estimates, like predicting bad debts.
Yeah, or warranty costs, asset useful lives, that kind of thing.
Yeah.
They also look at the overall information. Is it relevant, reliable, comparable, understandable?
So not just accurate, but usable.
Right. Do the notes, the disclosures give you enough information to understand what's actually happened with material transactions and events?
Makes sense. Anything else?
Just a couple more things. They check if the terminology used is appropriate, our title's correct. Is the overall structure and content presented fairly?
Right.
And ultimately, do the statements truly represent the underlying transactions and events in a way that achieves fair presentation? It's kind of the overarching goal.
Okay, that's comprehensive. Now let's talk outcomes. It's not always a perfect score, is it? What kinds of opinions can they actually issue?
No, definitely not always perfect. The best case scenario, the clean bill of health, is called an unmodified opinion. For public companies listed on stock exchanges, it's often called unqualified. Basically the same thing.
Unmodified or unqualified, meaning?
It means the auditor concludes the financial statements present fairly in all material respects according to the framework. That's what companies want.
The gold standard. But what if there are problems?
That's when we get into modifications to the opinion. This happens for one of two main reasons.
Okay.
Either the financial statements are materially misstated, that's a problem with the financials themselves.
Like a GAAP violation.
Exactly. Or, the second reason, the auditor couldn't get enough sufficient appropriate evidence. That's an audit issue, a scope limitation.
So it's either bad numbers or couldn't check the numbers properly.
You got it. And based on why there's a modification and how bad it is, we get different types of modified opinions.
Okay, let's break those down. What's the first level of modification?
That would be a qualified opinion. This basically says, hey, except for the effects of this specific issue we're flagging, the financial statements are presented fairly.
So it's like, mostly, okay, but there's this one specific material problem.
Correct. It's used when the misstatement, or the lack of evidence, is material, but it's not pervasive. It doesn't taint the whole set of financials.
Not pervasive. Okay, we need to define that. But first, what if the problem is more widespread?
Right. If the misstatements are both material and pervasive, then the auditor issues an adverse opinion.
Adverse? That sounds bad.
It is. An adverse opinion explicitly states that the financial statements do not present fairly. It's a pretty strong condemnation of the financials.
Wow, okay, so that's for material and pervasive misstatements.
Yeah.
What about when the issue is not being able to get enough evidence and that's pervasive?
Good question. If the auditor can't get sufficient appropriate evidence, and the potential effects of undetected misstatements could be both material and pervasive, they issue a disclaimer of opinion.
Disclaimer, meaning they just don't give an opinion.
Exactly. They state that they do not express an opinion on the financial statements.
Yeah.
They essentially couldn't do their job properly because of the scope limitation.
Okay, so qualified is, except for this one thing, adverse,
Hmm.
is these are materially wrong and pervasive, and disclaimer is we couldn't even form an opinion because the lack of evidence was material and pervasive.
That's a great summary.
Now that word pervasive, you used it for adverse and disclaimer. What makes something pervasive? Give us an example.
Sure. Pervasive effects are those that aren't confined to just specific accounts or items, or if they are confined, they represent a really substantial chunk of the financials.
Like that inventory example you mentioned earlier. If inventory and cost of sales are totally messed up.
Yeah, that could easily be pervasive because it hits assets, costs, profits, multiple key areas. It could also relate to disclosures that are fundamental to users' understanding. If those are missing or wrong, that could be pervasive too.
I see. It really impacts the overall picture significantly.
Right. And one important point, if an auditor gives an adverse opinion or a disclaimer on the whole set of financial statements, they absolutely cannot turn around and give a clean, unmodified opinion on just one part, like just the balance sheet.
Ah, okay. Can't pick and choose if the whole thing is unreliable or unverifiable.
Nope.
So, wrapping this up, what's the main thing you want our listeners to take away from all this?
The auditor's opinion isn't just boilerplate. It's a really critical assessment. Understanding the difference between unmodified, qualified, adverse, and disclaimer gives you powerful insight into how much reliance you can place on those financial statements.
It tells you a lot about the quality and reliability of the information.
Absolutely. Whether you're investing, doing business with a company, or just trying to understand its health, knowing how to read that opinion is key.
It really empowers you to look at financial reports with a more critical eye.
Definitely.
Okay, here's a final thought for you to chew on. We talked about materiality and pervasiveness. These clearly involve a degree of professional judgment by the auditor, right?
Oh, absolutely. Huge judgment calls.
So consider this. How might the inherent subjectivity in defining what's material or pervasive affect the consistency of audit opinions? Could two different auditors reasonably reach different conclusions on the same set of facts? And what does that imply about comparing opinions across companies? Something to think about.
That's a great point. The role of judgment is massive.
Thanks for joining us for this deep dive.